Hello and welcome to the deep dive. In a world just swimming with information, the real challenge isn't just finding it, it's distilling what truly matters, right? Finding those aha moments. Today, we're doing exactly that. We're going to unravel this fascinating investment puzzle. Why a giant like Coca-Cola, which you often think of as maybe a slow and steady kind of play, why it might just be considered a smart growth stock to buy right now.
It almost sounds counterintuitive, doesn't it? Yeah, so our mission today is basically to unpack the core arguments from this really detailed Motley Fool article by Ruben Greg Brewer. We'll break down his specific points for why Coca-Cola stands out as an attractive investment, especially, when you stack it up against other big household names like Costco or even its rival PepsiCo. It's going to be, I think, a fascinating journey to see what makes this beverage behemoth tick from an investment perspective.
Absolutely. And it's a great chance to look at how, specific traits of a really established company can actually signal growth potential, even in a sector that, well, let's face it, is facing some headwinds right now. What's interesting here is how the author frames the argument. It's not just based on raw growth numbers. It's more a combination of fundamental strength, market position, and crucially, valuation.
Okay, so the article kicks off by stating pretty boldly that Coca-Cola is one of the most important beverage companies in the world. Now, on the surface, that sounds, well, almost too obvious to be really insightful. But what does that truly translate to when we're thinking about investment appeal? What's the real meat there?
Well, that's the thing. It's not just a throwaway line. The article backs it up immediately. It highlights Coca-Cola's truly global presence. I mean, it's selling products everywhere. And its main brand, Coke itself, being one of maybe the best known on the entire planet. But it goes deeper than just brand recognition. It's about their industry-leading distribution, their marketing skills, their R&D. And if you connect this to the bigger picture, these aren't just buzzwords. They represent really significant competitive advantages. Things like that distribution network, the marketing muscle, the R&D. It means they can easily act as an industry consolidator. They've got the financial clout, right? And the operational expertise to just acquire promising smaller brands and almost instantly plug them into this massive global network, giving those smaller brands a scale and reach they could never achieve on their own. That ability to sort of absorb and amplify. That's a powerful ongoing growth engine right there.
Okay, I see how those advantages layer up. That makes sense. But, in a world that really values disruptive innovation, does being an industry consolidator still translate to exciting growth? Or is it maybe more about just, maintaining market share in what's arguably a pretty mature industry?
Well, it's both, and that's kind of the genius of it, right? It definitely maintains market share because they have this unparalleled reach. But it grows by bringing these promising new brands under its umbrella. It finds growth externally and scales it, which leads us perfectly into the article's comparison with Costco. Costco is called a great business that is growing well right now, yet the author suggests its valuation is so rich it probably isn't worth buying. So the puzzle piece here is, how does Coca-Cola manage to escape that same valuation trap? If it does. Yeah, and this brings it to a really crucial point about how we evaluate growth. Costco is a leader in the club store space, no doubt, and is performing exceptionally well. However, the author points out that sometimes strong performance can lead investors to bid the price up to, quote, astonishing heights. So for Costco, it's price-to-sales ratio, how much you're paying for each dollar of revenue. It's price-to-earnings, classic PE ratio, and it's price-to-book value, comparing market value to underlying assets. All those are notably above their 5-year averages right now. Plus, its dividend yield, only about 0.6%. That's well below the S&P 500 index average. So yeah, great growth business, but buying it today means accepting a pretty significant premium. You're paying up for it.
Right. Okay. So the Costco comparison definitely highlights that danger, an overvalued growth stock. Pay too much, get less return. But the article suggests Coca-Cola completely sidesteps this trap. And one of its most, maybe surprising arguments revolves around something called a Dividend King. What exactly is that? And why does this particular status make Coke such a compelling smart growth candidate right now?
Right. A Dividend King. It's a pretty elite group, actually. These are companies that have increased their dividend payment to shareholders every single year for over 60 years. 60 years.
60 years. Wow. Okay.
Yeah. Now, this isn't just, a nice little perk for investors. The insight here is profound, especially for a growth discussion. It shows you a management team with just an unparalleled track record of generating consistent, really robust cash flow, and, crucially, a deep commitment to returning value to shareholders through all kinds of economic cycles, good times and bad. So, in a world chasing maybe more speculative growth, A dividend king signals this highly predictable, resilient form of long-term wealth creation. It's a distinct kind of smart growth that maybe many investors might overlook.
That kind of track record, 60 years, it certainly speaks volumes about resilience. I get that. But the article also notes that the broader consumer staples sector, especially food and beverage, is kind of out of favor right now. You think about shifts towards healthier options, stricter regulations, things like that. So given those headwinds, how do we square that general market sentiment with Coca-Cola's actual business performance recently?
hmm And this is where that nuanced understanding really comes into play. It's a great point. While there's this broader Wall Street sentiment that's maybe a bit down on the sector because of those factors you mentioned, Coca-Cola's actual business performance, well, it tells a different story. In the second quarter, for instance, their organic sales advanced 5%.
5%, okay.
Yeah, and to put that into perspective, that's more than twice the pace of PepsiCo.
Ah, PepsiCo, the number 2 player.
Exactly, the number 2 beverage maker, so Coke's outpacing them significantly there. Furthermore, Coca-Cola updated its full-year earnings guidance. They actually increased it from an initial 2%, 3% growth projection up to approximately 3%, which clearly indicates the business is performing at the high end of its own expectations, kind of defying that general sector skepticism.
Okay, so the performance is strong, defying the trend maybe, and it's a dividend king, that long-term stability signal. What does all that mean for its valuation then? Compared to, say, PepsiCo, which the article apparently says has a more attractive valuation, how does that balance out?
Yeah, this brings up that key point about balancing growth with value. It's not always easy. While PepsiCo might look more attractive purely on valuation metrics, like PE ratio, the article attributes that lower valuation, at least partly, to its comparatively weaker business performance recently. Remember that 5% SES, less than 2.5% organic growth.
Right, the growth difference.
Exactly. Coca-Cola, on the other hand, it boasts price-to-sales, price-to-earnings, price-to-book ratios that are all near or even slightly below their 5-year averages, so not stretched like Costco's.
Okay.
And crucially, its dividend yield is nearly 3%. That's significantly higher than what you'd typically get from just holding an S&P 500 index fund right now.
Interesting comparison.
So while PepsiCo might be the pick for someone strictly seeking a value stock, maybe willing to wait for performance to improve, Coca-Cola seems to offer this compelling combination.
Yeah.
Demonstrated growth and a reasonable price, especially when you consider its robust performance versus its main competitor. So for an investor with, say, $1,000 to put to work, the article suggests acquiring about 14 shares of Coca-Cola. That would likely be the better option here, offering that growth without the kind of overextension risk you see in stocks like Costco right now.
Okay, let me try and wrap my head around this then. So what does this all mean for someone maybe looking to invest? We've got Coca-Cola, this global powerhouse, right? A dividend king over 60 years of increasing dividends. That's huge. Strong recent sales growth, actually outpacing its direct competitor, PepsiCo. And all of this seems packaged with a valuation that isn't outlandish, certainly not compared to a high flyer like Costco.
That's exactly it. That sums it up nicely. It's really about recognizing that growth isn't always tied to some astronomical valuation. You don't always have to pay through the nose for it. Coca-Cola presents a case where its inherent strengths, it's a global reach, brand power, distribution prowess, and that proven track record of returning value to shareholders through dividends, all that is combined with current strong operational performance. It's firing on cylinders now. And when you look at its valuation metrics compared to its own history and against its peers, it suggests you're not paying a massive premium for that current growth and stability, which makes it potentially an attractive option for someone looking for a company that can grow reliably, but without taking on the maybe speculative risk of a really overvalued stock, its growth at a reasonable price, perhaps.
Well, we've certainly journeyed through quite an exploration here, looking at why Coca-Cola is being flagged as this smart growth stock to buy right now. We've uncovered its powerful global presence, its really enviable status as a dividend king, its recent strong business performance, and importantly, its reasonable valuation compared to both its own history and other market darlings like Costco.
Exactly. And this whole deep dive really was aimed to provide you, the listener, with a kind of shortcut. A shortcut to being well-informed about this specific investment case. Understanding these specific details, those comparisons with Costco and PepsiCo, the real significance of being a dividend king, and the nuances of its valuation despite those broader sector trends. It allows you, hopefully, to quickly grasp the core arguments without needing to wade through, endless data yourself.
It really is about connecting those dots, isn't it? And as we wrap up, the author of this article we've been discussing, Ruben Greg Brewer, he has this quote that really sticks with you. He believes dividends are a window into a company's soul. So here's maybe a provocative thought for you to consider as we finish. If dividends can reveal a company's true nature, its long-term resilience, like a window into its soul, what other less obvious indicators, maybe qualitative factors, might offer a similar window? Something that could help you truly assess a company's long-term value beyond just the typical financial ratios you always hear about. Just something to mull over as you navigate this very information-rich world. Thanks so much for joining us on the deep dive. We'll be back soon with more insights.